Welcome to another edition of Taking Stock for the week ending the 13th of June 2025. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to your thing share markets. How are you, Matt, on this cold winter morning?
Yeah, it's exceptionally chilly here in Melbourne this morning, isn't it, Cam? But it is also very good to be joining you for taking stock.
Yeah, now good to have you on board, and great to see you're nice and healthy and avoiding the flu season. But before we get started, just a quick yet important reminder that the information we provide is of a generic nature today and shouldn't be taken as personal advice. Remember, shares are volatile, so past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, another positive week for equity markets, and that's driven by improving sentiment around this new trade framework between the US and China. This deal aims to secure access to the critical rare earths exports, which is essential for the automotive industry. And adding to the optimism as well, we had May inflation data in the US coming in slightly below expectations.
Yeah, it was nice to see that inflation data again come down. And locally, the Aussie market has followed Wall Street's lead, and that was propelled in part by resources stocks, which are rallying on this renewed optimism around the US-China trade discussions.
Mm.
And we've also seen a sharp rise in oil prices this week, and that has been driven in part by escalating geopolitical tensions between the US, Israel, and Iran. And of course, as we all know, Iran is one of the world's largest oil producers.
Yeah, that certainly helped some of our oil star stocks like Woodside and also Santos as well. But not all stocks are sharing the gains, though. We're deep in confession season, and several companies have downgraded earnings guidance due to this ongoing macro uncertainty. And one notable example during the week I noticed was luxury online retailer Cettire, which saw its share price plunge 30% after posting softer than expected sales and also pressure on their margins. You've got heavy promotional activity, weak demand, and pressure from US tariffs all weighing on its performance.
Yeah, Cettire was always one of those head scratchers, wasn't it, Cam? We
Mm.
couldn't quite get our head around the business model and its sustainability. So I'm glad that you and your team didn't elevate it into the star stock universe when it was presenting as a reasonable looking idea. And meanwhile, fertility treatment provider Monash IVF remains under significant scrutiny after yet another clinical error that triggered a sell-off earlier in the week. Now, for the good news for investors is that the share price has rebounded somewhat, but the incident highlights just how sensitive the healthcare sector can be to reputational risk.
Yeah, and on the corporate front as well, Matt, we had M&A activity gaining momentum. We had shipbuilder Ostel and Johns Ling, a specialist in disaster recovery construction. They both reportedly were in the sights of potential acquirers, adding to this deal-making buzz across the mid-cap space as well. But now let's turn our attention to some star stock highlights this week. We have Austin Engineering, a global manufacturer of truck bodies and mining equipment.
Yes, and again, the company downgraded its financial year 25 underlying earnings forecast down to 41 million, which is a notable drop from the earlier 50 million that they provided guidance around earlier in the year. Now, although this is weaker, the revised guidance still represents an 8% uplift on the previous year. The downgrade reflects weaker than expected margins, primarily due to a large contract in Chile that strained local capacity without the ability to compensate by rising prices.
Yeah, this recent margin pressure does raise concerns about Austin Engineering's ability to meet its ambitious return on equity target at above 25% for this year, while also adding to the uncertainty of the outlook, particularly given the limited analyst coverage. Despite these challenges, though, we've chosen to maintain coverage on the stock as the issues do appear operational and likely short term rather than structural. Management is proactively addressing the situation by redirecting production to its Batam facility in Indonesia, aiming to restore profitability and alleviate this capacity constraint.
And encouragingly, the revenue outlook remains pretty strong, supported by improved manufacturing capacity in the US and a robust order book exceeding 200 million. That said, investors should remain aware of the inherent risks that are inherent operational risks that come with investing in mining stocks.
Yeah, that's right, Matt. And in Austin's case, these risks are compounded by the fact that it does have relatively low trading liquidity, which can amplify its share price volatility in response to company-specific developments like this.
And fresh off the press, another stock to release a profit downgrade late in the week is Star Growth and Star Income stock footwear retailer Accent Group.
Mm.
It's a difficult trading environment at the moment for retailers right now. Promotions are cutting deeper, consumer spending is soft, and global brands like Nike are pushing more of their sales direct to consumer, bypassing traditional retailers like Accent Group. And at the same time, its bold Sports Direct rollout is soaking up a fair bit of capital, and this won't be contributing meaningfully to earnings until financial year 2028.
Yeah, certainly the recent interest rate cuts aren't contributing to the consumer sentiment at the moment. And with earnings guidance well below expectations, we expect these earnings revisions to flow through over the next few days and put pressure on its return on equity, currently at 16%, and also put pressure on its dividend payout ratio at around 70%. As a result, we're placing Accent Group under review while we look at the challenges, which it looks like the path to recovery is longer than anticipated. Events like this really underscore the importance of maintaining a diversified portfolio and understanding those active risks before you're taking on the investment. Not every decision will go your way, and confession season certainly serves as a timely reminder of that reality. Moving now to another Star Growth stock and property classifieds business, REA Group, Matt.
Yeah, look, they're facing multiple headwinds at the moment. Firstly, the ACCC has launched an investigation into potential misuse of market power after significant price increases, up to 78% of subscriptions and 14% for listings. Now, although subscriptions account for just 5% of the overall revenue, there are concerns about REA's dominant market position and aggressive pricing strategy. So while short-term earnings may hold, continued regulatory scrutiny could limit pricing flexibility and dampen their long-term growth prospects.
Yeah, and speaking about their dominant market position, Matt, that might be under threat. We had CoStar's 3 billion acquisition of Domain, giving it a strong platform to scale quickly as well. You've got the global backing and also a vendor-paid low-cost strategy focusing on user experience. CoStar could challenge REA's pricing power and force it to invest more towards marketing, placing additional pressure on its 32% net profit margins and long-term market dominance.
Yeah, look, the number twos have always tried to win market share off REA and failed in the past, so we will be watching this closely. Adding to the pressure, listing volumes in April and May were also down 10% year on year. If this trend does continue through the fourth quarter, earnings could soften, which may weigh on full year results. So with the macro regulatory and competitive risks converging, REA's forecast return on equity of 32% does face some downside pressure.
Yeah, so we're watching that very closely. And for investors holding REA, these risks are worth monitoring as the company heads into its full year result in August. Still, we continue to classify REA as a Star Growth stock. It does, as you said, Matt, it's repeatedly proven its resilience through various cycles, underpinned by a dominant market position. It's got very strong brand equity and an innovative, scalable digital business model supported by structurally sound housing markets. In Under the Microscope this week, let's focus on hearing implant manufacturer and Star Growth stock Cochlear. The company just downgraded its full year earnings guidance by around 4 to 5%. And this is the third downgrade in a row. So it's definitely raised a few eyebrows, Matt.
Yeah, that it has, Kien. And for anyone unfamiliar, Cochlear manufactures and designs hearing implants. So these are devices that obviously help people with severe hearing impediments. Now, the revenue comes from two main areas, and that's selling new implants and servicing existing patients, especially through upgrades to their sound processors.
Yeah, exactly. And it's that services side, which makes up around 26% of their total revenue, is where the trouble is. They were expecting a small dip in upgrades after a recent product cycle, but the decline is now looking more like double digits. You've got cost of living pressures and delays with insurance approvals. That seems to be dragging things down by more than expected. But Matt, What was interesting was that the share price didn't really react too badly. You'd think that three downgrades would spook the market.
Yeah, it's a good question, Ken, and a pleasant surprise to see the share price up on a day where they had announced another downgrade.
Mm,
So I think reading between the lines here, I think the downgrade was very much priced into the share price.
mm.
And plus, Cochlear is rolling out some new products. They've got the Cochlear Implant 1000 and the Nucleus Nexa processor, and this is coming out in Europe and Asia Pacific right now. That's giving investors some confidence that growth could rebound over the next 12 months.
Yes, and looking at the outlook, the return on equity numbers, especially in financial year 26, do look strong. So there's an expected recovery there as well. But still, three earnings downgrades in a row does raise some concerns. Is there a chance this turns into a longer term issue?
Look, at this stage, it looks more cyclical than structural. The
Mm.
services slowdown is tied to timing after a strong upgrade cycle and temporary affordability issues. Their core implant business is still growing, especially in emerging markets, though margins there are a little thinner. So I wouldn't be surprised to see some margin decline over the next 12 months.
Yeah, its net profit margin is incredible at around 17%. But the stock is now trading well below its highs. Should investors view this as an opportunity?
In the near term, Cochlear faces several headwinds that cloud visibility on their earnings, not only for the unexpected delay in the sound processor upgrade cycle, but also from external factors such as currency volatility and evolving US trade policy, especially those affecting China and imported manufacturing components. But that said, investors willing to look through the short-term noise may see this as an opportunity to gain exposure to a very high quality business with strong competitive advantages and its consistent product innovation and long-term structural growth drivers.
Now to question of the week. With the markets firing along, a useful question for investors this week is how can Stock Doctor help members take profits and rebalance their portfolios, especially as we head into the end of financial year and reporting season?
Yeah, it's quite timely that we're asking this question, isn't it, Ken? As markets continue to perform very strongly, particularly here in Australia, with star growth stocks returning close to 20% this year. Now is a good moment for investors to step back and review their portfolio and positioning. A key principle in portfolio risk management is not letting strong performers become too dominant in the portfolio, as this increases exposure to stock-specific risks.
Yeah, that's right, Matt. And Stock Doctor's portfolio manager and optimizer tools can help investors do exactly this by facilitating strategic profit taking, reducing concentration risk, and also realigning your portfolios to its original investment objective.
So to start, select your portfolio and head to the Portfolio Optimizer tab. Now, this feature allows you to view and manage your exposure to individual holdings. If a stock has grown to occupy more than about 10% of your portfolio, it may be time to trim the position. This ensures your portfolio isn't overly reliant on the fortunes of a single company.
Yeah, good point. And the color-coded system in the optimizer, it helps you visually assess each stock's alignment to your objective and risk tolerance as well. Stocks showing a red circle may no longer meet your criteria, either due to weaker financial health or it's not part of our star stock universe. These can be candidates for removal. And if you have reason to retain a stock that doesn't really align perfectly, you can lock it to exclude it from the optimizer recommendations.
And after adjusting your holdings, you can replace remove stocks with alternatives suggested by our algorithm. And these are tailored to your specific objectives and the risk profile of your remaining portfolio. And once satisfied, you can click Weight Evenly to balance your holdings and then review the specific buy and sell instruction under View Orders.
Yes, Stock Doctor does make this quite easy there, Matt. Ultimately, though, rebalancing isn't just about locking in gains. It's about keeping your portfolio consistent with your investment objectives, controlling risk, and also building up cash to take advantage of opportunities, especially with the upcoming reporting season. But that's all we have time for today, Matt. It's a long one, but very insightful as always.
It was. And if you do have any question, please feel free to join us for Lincoln Live on Monday morning.
Yeah, and we look forward to welcoming our members at our upcoming cocktail events in Sydney and Melbourne next week as well. And if you have family and friends who you believe could benefit from Stock Doctor, now is an ideal time to refer them with our special end of financial year offer currently available. The success of our business is built on the ongoing support of our members, and for that, we are truly grateful. Take care and have a happy, healthy, and prosperous week ahead.